Welcome to The Explainer. Today we're diving into something that is absolutely critical for long-term financial planning here in Canada. We're talking about the Registered Disability Savings Plan, or, the RDSP for short. Basically, it's a registered plan offered by the Government of Canada, specifically designed to help people with disabilities save up for long-term financial security and retirement. Used right, it's a real game changer.
So here's our roadmap for today. We're going to cover eligibility and plan setup, beneficiary and holder cases, government bonds and grants, contribution limits and maximums, withdrawals and the 10-year strategy, and then we'll wrap up with a practical Rdsp timeline. Let's jump right in.
Section 1. Eligibility and Plan Setup. Okay, so to become eligible for an RDSP, a person must first apply for the Disability Tax Credit, commonly known as the DTC, through the Canada Revenue Agency. You absolutely have to get that prerequisite approval first. Once the DTC is approved by the CRA, the person officially becomes eligible, and the plan can be opened under 3 different situations, depending on the beneficiary's condition.
Section 2. Beneficiary and holder cases. Let's look at those 3 different setup situations we just mentioned.
Right, so here are the 3 account holder scenarios. Case 1 is a minor beneficiary. If the beneficiary is a minor, the parents or legal representatives can open the RDSP on behalf of the child. In this situation, the parents or legal representatives become the holders of the account, while the child is the beneficiary until reaching the age of majority. Moving to Case 2, adult beneficiary who is not financially competent. If the beneficiary is an adult but is not mentally capable of handling financial affairs, then similar to the previous case, the parents or legal representatives can become the holders of the account. And finally, Case 3, adult beneficiary who is financially competent. If the beneficiary is an adult and financially competent, meaning mentally capable of managing personal financial matters, then the beneficiary becomes the holder of the RDSP personally.
Now, this is a crucial point to remember. The only beneficiary of an RDSP must be the person with the disability, nobody else. If the holders of the account want another person to manage or oversee the RDSP in the future, they really need to specify that person in their will. Otherwise, if there's no will or no designated person, the future control of that account may end up being determined through the estate process, which can obviously get a bit complicated. All right, Section 3, Government Bonds and Grants. This is where the math gets really fascinating.
After the RSDSP is successfully opened and registered with Employment and Social Development Canada, the account might become eligible for 2 different types of government contributions, Canada Disability Savings Bonds and Canada Disability Savings Grants. Understanding the distinction here is key. With bonds, no contribution is actually required. If the beneficiary qualifies based on family income, the government may just deposit up to $1,000 per year into the RSDSP for low-income families. Grants, on the other hand, do require a contribution. To receive grants, the holder of the plan must contribute money into the RSDSP. Based on the amount contributed, the government matches part of the contribution. Generally speaking, if the holder contributes $1,500, the government may contribute up to $3,500 in grants depending on income eligibility. That is an incredible matching rate.
But how exactly do they determine that income eligibility? Well, for financially competent adult beneficiaries, calculations are based on the beneficiary's own family income. But for minor beneficiaries or financially incompetent adults, calculations are based on the income of the primary caregiver. And to be clear, the primary caregiver is the person receiving the Canada Child Benefit for the child. That means only one parent can be considered the primary caregiver for RSDP calculations at a given time. Now, for higher income families, bond eligibility may disappear completely, and grant matching rates may decrease to $1 of grant for every $1 contributed, up to certain limits.
Let's move to Section 4, Contribution Limits and Government Maximums. We've got some very specific, important numbers to look at here. First up, let's look at personal contributions. Over the lifetime of the RDSP, total personal contributions can reach up to $200,000.
When it comes to time limits, government grants and bonds can be received for a maximum of 20 years.
And what about the actual dollar amounts for the government? While they're super generous, the lifetime maximum government contribution is up to $20,000 in bonds. And a massive $70,000 in grants.
But there's a strict timeline applied to those maximums. All grants and bonds must be received no later than December 31st of the year the beneficiary turns 49. After age 49, the government completely stops contributing to the RSDP.
Which brings us perfectly to Section 5, Withdrawals and the 10-year strategy.
Since the RDSP is mainly designed for long-term savings and retirement, withdrawals without penalty generally begin after the beneficiary turns 60 years old. After age 60, there's actually a mandatory minimum annual withdrawal amount. But what happens if someone urgently needs money before age 60? Well, in that case, withdrawals are still possible, but there may be penalties related to government contributions. The math here is really eye-opening. The holder can always access personal contributions, but for every $1 withdrawn, up to $3 of government grants and bonds may need to be repaid to the government. For example, if someone wants to receive $1,000 personally from the RDSP, the total withdrawn may need to be $4,000 because $1,000 goes to the beneficiary and $3,000 is repaid to the government. Ouch.
The whole reason behind this penalty is something called the 10-year rule. Simply put, the 10-year rule states that grants and bonds must mature for 10 years after the last government contribution before you can make penalty-free withdrawals. You literally have to wait a full decade.
But here is an incredibly important and sometimes overlooked strategic use of that 10-year rule. Suppose a family opens an RDSP for their child at a young age. Step 1. For several years, they consistently contribute enough money to maximize available grants and bonds. Step 2. Then, after receiving substantial government contributions, they formally request a revocation, meaning they actually ask the government to stop depositing additional grants and bonds into the account. At that point, the 10-year waiting period begins. Step 3. During those 10 years, the disability tax credit must remain valid. Otherwise, the waiting period may be interrupted or reset. And finally, Step 4. After the 10-year period is completed, withdrawals can begin without repayment penalties, even if the beneficiary is still much younger than age 60. It's brilliant.
And there's another major rule here related to retroactive RDSP payments, and the potential scale of this is just massive. Depending on the nature of the disability, the CRA may approve the disability tax credit retroactively for previous years, sometimes all the way back to birth. The government can actually go back up to 10 years and provide missed grants and bonds for those years. In a single year, retroactive payments can reach up to $11,000 in bonds and up to $10,500 in grants. That alone makes the RDSP one of the most powerful government-supported savings programs available anywhere in Canada.
Finally, Section 6, a practical RDSP timeline. Let's wrap everything up by putting all these rules into a real-world example. Consider this scenario. John applies for the disability tax credit for his 7-year-old son and receives approval retroactive to birth. For the next 13 years, John contributes regularly to the RDSP and receives both current and retroactive grants and bonds. By the time his son turns 20, the RDSP has accumulated significant government contributions. At that exact point, John files a revocation request to stop future grants and bonds. Then the family simply waits another 10 years so the grants and bonds can fully mature under the 10-year rule. During those 10 years, the disability tax credit remains valid. Finally, after the waiting period ends, withdrawals can begin entirely without repayment penalties, while the son is only 31 years old.